Best long-term stocks to buy and hold. Long-term investors ignore the churning, short-term rise and fall of stock markets. Rather than getting caught up in the drama, they buy the shares of stable companies with reliable performance that's measured in years or even decades. The best long-term stocks are growing businesses that deliver steady returns. To find them, you need to understand the metrics that provide solid evidence of dependable long-term performance. Things like regularly outperforming the S&P 500 and avoiding the big drops and gains that high-flying stocks tend to see over the short term. Forbes Advisor has identified stocks that could be great long-term investments. Each of our picks are backed by steadily rising earnings and sales and have seen smaller price drops than 95% of the stocks in the market. As an added bonus, most of these equities are currently trading at cheaper valuations than they've seen in years. Broadcom Inc. Why we picked it. Broadcom is a diversified semiconductor manufacturer that was formed in the merger of Avago and Broadcom. The company produces microchips used in high-end smartphones, televisions, and a broad selection of wireless devices. Broadcom has the most attractive forward P/E ratio on our list at 12.2. The company's lowest P/E ratio over the last 5 years was 8.1, so its current valuation is attractive. This is mainly due to the fact that Avgo is trading about 30% below its 52-week high. Over the last 5 years, earnings per share EPS has been increasing by an average of 77% per year, from $4.20 in 2017 to more than $23 per share in the last 12 months. Analysts expect EPS to grow by an average of 15.2% per year over the next 5 years. Avgo's share price has strong historical performance, outpacing the S&P 500 by 7.5% per year over the last 5 years. It also offers the highest dividend yield on the list at 3.3%. The company has steadily increased its dividend for more than a decade. Tractor Supply Company. Tractor Supply is the largest retail operator of farm stores in the U.S., with a focus on home improvement, lawn and garden, and recreational farmers. It operates more than 2,000 stores under the Tractor Supply and Petsons banners. Over the last 5 years, TSCO's lowest P/E ratio was 14.8, making the current P/E of 18.2 an attractive entry point. Currently, the stock is trading 21% below its 52-week high. The company has grown EPS by an average of 22% per year over the last 5 years, and analysts expect EPS to grow by 10.5% per year over the next 5 years. The stock has seen strong price performance, outpacing the S&P 500 by more than 16% per year over the last 5 years. Tractor Supply pays a 1.9% dividend yield, and the company has regularly boosted its dividend payout for years. Integris, Inc. Integris supplies materials and technology to the global semiconductor industry. INTG has the second highest trailing EPS growth rate on our list, after Broadcom. The company's 32% annual EPS growth rate is expected to slow to a still very respectable 17% annual rate over the next 5 years. For that kind of growth, a forward P/E of 19 is respectable. Over the last 5 years, INTG's P/E has ranged between 17 and 62, so the stock is priced cheaply by historical standards. The company is currently trading about 42% below its 2021 all-time high. In terms of stock performance versus the benchmark, INTG is the second best on our list. INTG has outpaced the S&P 500 by an average of 16.8% per year over the last 5 years. Dollar General Corporation. Dollar General is one of the largest U.S. discount retailers, operating more than 18,000 stores in 47 states. Most of the company's stores are located in small towns that are not served by larger retailers, like Walmart. Over the last 5 years, the company has delivered 18% average annual EPS growth. Analysts expect that growth rate to slow slightly, with 11.4% average annual EPS growth over the next 5 years. Dollar General is trading at a forward P/E ratio of 19.4. That makes the stock attractive, given that its P/E values generally fluctuate between 15 and 30. DG has outpaced S&P 500 gains by an average of 16.4% per year over the last 5 years. That's one of the best track records on this list. Dollar General has a shareholder yield of 4.4%, thanks to a combination of generous stock buybacks and dividends. The dividend yield is currently 0.9% for the last decade. DG has continually reduced the number of shares outstanding, boosting the yield. Unit Health Group Incorporated. United Health is a large private health insurer covering more than 45 million Americans and 5 million members outside the U.S. The company has been growing EPS at an annual rate of more than 18%, and analysts project 14.3% yearly earnings growth over the next 5 years. UNH has a forward P/E ratio of 21. That puts it closer to the lower end of its 5-year P/E range of between 14 and 33. The company has outperformed the S&P 500 by an average of 12.8% per year over the last half-decade. The company offers a dividend yield of 1.3% and has steadily increased dividends for years. UNH boasts a shareholder yield of 2.4%, as it has been reducing the number of shares outstanding over recent years. Brown & Brown, Inc. Brown & Brown is an insurance agent and broker, primarily focused on property, casualty, and employee benefits insurance. As a broker, the company collects commissions and assumes very little underwriting risk. Bro has produced annualized EPS growth of 18% over the last 5 years. Analysts expect 13.2% yearly earnings growth over the next 5 years, with the stock about 17% off its all-time high in April 2022. Brown is priced attractively. The forward P/E ratio stands at 24, in the middle of the range between 16 and 36 seen over the last 5 years. Brown & Brown has garnered returns of 11% per year above the S&P 500 returns during the last 5 years. It currently offers a modest dividend yield of 0.7%. Apple Inc. Apple is the largest U.S. public company by market capitalization and needs no introduction. It boasts the strongest stock performance on the list over the last 5 years, outpacing the S&P 500 by more than 22% per year. The company has seen strong average EPS growth of 22.3% over the last several years, although this rate is expected to drop to 9.5% over the next half-decade. That represents the lowest expected forward earnings growth on the list. The stock is trading 14% below its 52-week high, at a forward P/E of 24.4. This is a decent entry point for the stock. The P/E range over the last 5 years is 12 to 44. The dividend yield is a modest 0.6%, while the shareholder yield is an impressive 4%, as the company has been working hard to reduce the number of shares outstanding. S&P Global Inc. S&P Global provides corporate credit ratings and benchmarks for financial markets. The company's flagship S&P 500 index is one of the most followed stock indices on Earth. The company has been a steady grower, increasing their EPS by an average of 9.2% per year over the last half-decade. That's the lowest growth rate on our list, but analysts expect earnings to increase to an annualized rate of 12.6% over the next 5 years. SPGI's forward P/E ratio of 24.5 provides a decent entry point for a long-term investor. The 30% price decline from the 2021 high has brought the stock to the low end of its 5-year P/E range between 18 and 47. The stock has been a steady performer, averaging annual price gains more than 7 percentage points greater than the S&P 500 over the last 5 years. Mastercard Incorporated. Mastercard is one of the world's largest payment processors. It has grown annual earnings by nearly 20% over the last 5 years. Analysts expect that growth to continue with 20.8% yearly EPS gains going forward. MA is about 22% below its early 2021 all-time high. The forward P/E of 24.8 is justified given the stock's impressive growth rate. It is also one of the cheapest valuations in terms of P/E the stock has seen in a while, as it has ranged between 29 and 60 over the last 5 years. In alignment with its growth, MA has delivered an average annual price appreciation that's nearly 7 percentage points over the performance of the S&P 500 over the last 5 years. Costco Wholesale Corp. Costco has built a cult-like following among its retail customers and investors by offering a membership-based shopping experience and low-priced goods at stores and online. The company has steadily grown EPS over the last 5 years, with an average increase of 16% per year. Analysts expect 13.7% annualized EPS growth over the next 5 years. Costco's stock price has fallen along with the broader market in 2022. It is currently down 18% from its April 2022 all-time. Even then, it's the most expensive stock on the list in terms of PE valuations. That said, a forward PE of 34.5 is still decent, considering the lowest PE that Cost has seen in the last 5 years is 27. Cost has outpaced the S&P 500 by an average of more than 16 percentage points per year over the last 5 years, which may also warrant the higher PE value. Costco offers a dividend yield of 0.7%. Payouts have steadily increased, and every few years the company has provided a higher dividend as a special one-time payout. During the global financial crisis of 2007 to 2009, Walmart Inc. was the one company out of all 30 constituents in the Dow Jones Industrials Average to post a positive return between the beginning and end of the 2008 bear market. During the COVID-19 sell-off of March 2020, Walmart also regained all its losses within a couple of weeks and hit a new all-time high in April 2020, during the height of the pandemic. Walmart is hardly the only blue-chip company that can hold up during a downturn, though. These 7 current and former Dow Jones component stocks all performed better than the broader market during both the 2008 meltdown and the 2020 COVID-19 crash. The distinct features of these 7 companies should make them resilient in the next recession as well. Discount retailers such as Walmart are the ultimate recession-proof businesses. People may forego luxury shopping for an extended period. But folks have to pick up bread, toothpaste, pet food and other necessities with regularity. And whether they're going to the store or shopping on Walmart's e-commerce site, they may end up buying some other discretionary goods as well. Not everyone may love shopping at Walmart, but few retailers offer more value for the money. Walmart stock has traded roughly flat over the past 2 years, as the initial gains from pandemic-era shopping wore off. Supply chain and inflation issues have also caused pressure on Walmart's profit margins. However, Walmart is adjusting its inventory ordering to reflect the changing consumer environment. Meanwhile, the weakening economy should help drive more business at Walmart going forward. McDonald's was one of the best-performing stocks of major blue chips during the 2008 financial crisis, and it also bounced back quickly in 2020. It benefits from similar factors as Walmart. People need to eat, and during difficult economic times, cheapness tops other factors. Folks may prefer more fancy or gourmet options, but McDonald's ability to provide fast, tasty, filling food at a low price makes it unbeatable during a recession. McDonald's has another perk that separates it from many restaurant peers: its real estate holdings. McDonald's is one of the world's largest owners of commercial real estate. During inflationary times, the value of McDonald's land parcels tends to increase significantly, making the company's overall value rise even if its sales or profits temporarily slip. McDonald's isn't glamorous, but during a recession, that's a feature, not a drawback. Most investors associate Home Depot with the housing market. As such, it must have crashed in 2008, right? No, it didn't. Home Depot stock only dropped 12% in 2008, while the broader S&P 500 plunged 37%. Home Depot held its ground even as the economy crumbled due to problems in the housing and mortgage markets. The takeaway is that Home Depot isn't simply a bet on new home construction. In fact, during hard economic times, people may spend more on home repairs and maintenance to get the most out of their existing living arrangements. Foreclosures and other events that trigger changes of ownership at a house can lead to additional spending on building materials as well. Regardless of Home Depot's strength throughout the housing cycle, the bears are at it again, predicting doom and gloom for Home Depot, and the stock is down 31% year to date. That's an opportunity for long-term investors. Procter & Gamble has been a long-time giant in consumer staples and currently generates roughly $80 billion in annual revenues. The company had a rough patch in the 2010s as it struggled to grow amid rising competition. However, the personal care and cleaning products giant is back on a winning streak, posting at least mid-single-digit organic growth over the past 4 years. As it turns out, Tide, Pampers, Gillette, Head & Shoulders, and Febreze still hold a ton of appeal to consumers during volatile times. In recent years, P&G also reconfigured its brand portfolio, selling off weaker brands while refocusing its efforts on its strongest category leaders. Though consumer preferences change over time, P&G has been able to roll with the punches. As proof of that, it has hiked its dividend an incredible 66 years in a row, making this an ultimate safe haven pick for income investors. Pfizer has been one of the most successful pharmaceutical companies of the past few years. According to data analytics company Global Data, Pfizer enjoyed the third fastest revenue growth out of the world's 20 largest biopharma companies between 2020 and 2021. Pfizer trailed only BioNTech and Moderna Inc. over that stretch. Investors might conclude that Pfizer is just a one-trick pony as it pertains to COVID-19 vaccines. However, Pfizer stock has historically performed well through recessions and economic cycles. The demand for life-saving drugs tends to be stable regardless of economic conditions, and having the government as a major buyer of pharmaceuticals insulates the industry from economic swings. Pfizer stock is currently undervalued. It trades for less than 8 times estimated 2022 earnings and offers a 3.5% dividend yield. The healthcare sector is a great place to find recession-proof stocks. And Johnson & Johnson is a unique example even within the sector. That's because J&J is broadly diversified and operates 3 different major businesses. It has a large pharmaceutical operation which generally contributes around half of its profits. Then there's the firm's medical devices, plus J&J also sells products for consumer health and wellness. This mix of divisions ensures that some part of J&J's business is outperforming regardless of what's going on with the economy or healthcare industry. Recently, medical device sales have struggled with hospitals delaying elective surgeries due to COVID-19. However, J&J should enjoy a recovery as hospitals return to more normal schedules. Meanwhile, shares sell for less 16 times forward earnings and offer a 2.7% dividend yield. Returning to 2008, one of the best performers in the Dow Jones Industrials Average was Kraft. The purveyor of packaged foods enjoyed strong demand as people ate more at home instead of eating out. Kraft has been through a corporate evolution since 2008. It spun off its Mondelez International Inc. confectionery and beverages business. After that, Kraft made its industry-defining merger with Heinz. For some time after, Kraft Heinz did suffer through issues with slow growth and excessive debt following its merger. However, the company has rallied sharply from its lows. Kraft has enjoyed a better sales environment as the wave of inflation has allowed substantial price hikes. Shares are once again cheap, trading for less than 13 times this year's estimated earnings while offering a juicy 4.6% dividend yield. That's an attractive valuation for a reliable defensive stock. Subscribe for more videos like this.